Year to date, Affirm Holdings stock is down 81%. But over the last 24 hours, stock's up 50. Do you sell the rip or do you buy the dip on Affirm Holdings? We'll talk about that and more on today's show. What is going on, investors? Hopefully, guys are doing well out there. Time to talk about Affirm, an interesting company that we've been covering several times here on the channel. They still got about a $5.86 billion market cap on this one. It's probably closer to 5, but in the after hours, it's popping up about 27%. That's on the heels of these Q3 earnings that came in. And I tell you what, I think right now we're getting to the point in the stock market where the Wall Street is just expecting the bottom to fall out of all of these stocks, and that's certainly not the case when it came to Affirm. Revenue came in at $354 million. That was 53% growth on this one. They beat expectations on that revenue side by about $10.8 million. On its own, I don't think that necessarily drives the stock that much higher, but in the after hours, they also gave us guidance for the upcoming quarter. In a quarter where we've seen Amazon and Shopify and eBay and Etsy and Facebook and all these different retailers and kind of discretionary type companies that kind of feed into that market, they've all pulled back their revenue guidance. Okay, they all have, including Shopify as well. Well, actually Affirm or kind of reaffirmed their guidance for the Q4, expecting revenues to come in between 345 and 355 million. Okay, we just printed a quarter where we did about 355. They're projecting maybe slightly lower or flat growth quarter over quarter, but the revenue estimates were kind of in the midpoint there at about 353. They also gave us guidance for the full year, expecting revenues to be right at about $1.33 billion. That's right about where the street was expecting. So now you're starting to see a little bit what's happening on Wall Street, especially with stocks like Affirm that have literally just absolutely gotten destroyed over the past year as this price just has rapidly declined. I mean, this stock was way up here over $160 per share, and it bottomed out more recently down here at about $14, $15 per share. That was like a 90% drawdown. So we're seeing what happens when stocks like this, high beta type stock. So a high beta type stock, if the market moves 1, well, if it's got like a beta of 2 or 3, well, it would move 2 to 3 times that. I think we're basically seeing that with Affirm, okay? The S&P 500 is down about 20%, and Affirm is down nearly 4 times that. So stocks like these are going to bounce around. I tell you what, just broadly speaking about the market, over the next maybe quarter or two, you're going to have a lot of opportunities like this where stocks like these get absolutely hammered, and then they have these massive rallies. Now, technically, we'll talk about this, we're still in a downtrend here. So there's some things that you need to realize. Certainly, if you're going to go long a position like Affirm, you really have got to be careful with that in that sense. Now, in terms of the numbers, we talked about how they had this $354 million worth of revenue. That was up 53% year over year. You see here, they were at $230 million last year. For the 9 months, paints a similar picture, 608 to 985. We're seeing on the operating expense side, though, things are not getting much better. So while the technical picture, at least especially over the last 24 hours, certainly looks a lot better, but certainly over the last 6 months or so, the technical picture and the price and the value of this stock has just absolutely been beaten down. And that is because their total operating expenses continue to exceed that revenue mark. So you notice that our revenues went up by about $124 million from 230 up to 354. That's $120 million gain, give or take some bucks. Now, in terms of our operating expenses, you see here, those went up by over $140 million. So our expenses are accelerating faster than our revenues. We had $581 worth of expenses. We minus off our revenue of $354. That gets you to an operating loss in the quarter at $226 million. Last year on a quarterly basis, you're sitting closer to 209. You see for the 6-month period as well, or excuse me, the 9-month period. So over 9 months over at Firm, last year you're sitting at a $270 million loss. Now it's accelerated up to 588. And again, I'll remind you, this is a company that's guiding to basically flat revenue growth in the upcoming quarter. I doubt they'll be able to lower these costs any significant amount. So they are also going to run at an operating loss coming into next year. Now, from a balance sheet perspective, they've got plenty of cash over here. Okay. They've got tons of cash sitting on the balance sheet. They got a couple billion. This company just more recently went public. And so, yeah, they have some money sitting there. The other thing that I want to point out to you is a lot of you make the argument that, look, a lot of these operating expenses down here out of this 581, some of this is stock-based compensation. But I do want to show you in the most recent quarter, it actually declined. We went from stock-based compensation last year from 180 down to 98 million. Okay. And so in some ways that is good because you're not really seeing dilution, but that also means more cash is actually flowing out of this company, considering our operating expenses went to 580 and stock-based compensation as a percentage of that actually went down quite a bit. So there's actually a fair amount of cash flowing out of this company from an operating perspective. And again, it's because when your stock makes this type of rapid downward move, well, it gets a heck of a lot harder to compensate your employees in that sense. Now, from a cash flow perspective, seeing a little bit of an improvement, especially over the last 3 months. We pulled down a net loss of 287. We get a $54 million or close to $55 million net loss in the most recent quarter. And you get positive cash flows, or excuse me, negative cash flows after you have all your add backs. Again, one of the things we talked about is the stock-based compensation went down to about 98 million. Last year, you're almost double that at about 180. But one thing that we do know when we analyze these kind of financial companies is they're constantly have a lot of like cash flow situations that are different than from traditional companies. So a company like Affirm might have a lot of loans that they're holding for sale. They originated a bunch of loans. This quarter ends on March 31st. Let's just say Affirm originated a ton of loans on like March 30th. Well, that would impact their cash flows because chances are they didn't have a chance to sell those loans or have those reach some kind of maturity or collect the fees on that loan. And so from a cash flow basis, you can evaluate Affirm, and it certainly got better quarter over quarter, but I would more be focused on, number one, this revenue growth, but also how these costs start to come in line. Because if this revenue growth starts to tail off even just a little bit over at Affirm, well, then obviously these expenses will really have to come in as well in order for this company to start making profits. Now, in terms of the earnings estimates, analysts are projecting kind of low 40% growth for this one for the next essentially 2, maybe even almost 3 years on this company. So there are massively high expectations on Affirm. Despite the massive drawdown on this stock, Wall Street's expecting kind of mid 40s or low 40s growth on this one for the foreseeable future. From a profit perspective, we are not going to be profitable over any of that period of time, according to analysts. Look at this. EPS estimates all the way out to fourth quarter of 2024, which is over 2 years from now. Investors, or in this case, analysts, are still not projecting a profit. And so you have to ask yourself, if you're going to come in here and buy the dip on Affirm, you think, look, you've got a $5 billion valuation on this company. They've got plenty of revenue, but the profit's just simply not there. You have to ask yourself, will the market have an appetite for Affirm losing money for the next 2 years in a higher rate environment where you can put your money in far less risky assets and maybe earn 4%, 5%, 6%? You have to ask yourself, will the market have tolerance for, yes, a company growing their top line 40%, but their earnings and their EPS basically going nowhere because they continuing to have to send money on sale? I mean, look at sales and marketing in the most recent quarter. Went from 58 to 156. We talked about how we grew our revenues by $120 million in the most recent quarter, where guess what? They increased their marketing spend by basically $100 million. So yes, if I'm running a business and I'm nearly triple my marketing spend year on over year, yes, I would expect to have some revenue growth. So there's that with Affirm. There's also a lot of competition. You just have to analyze how the market's going to analyze these types of companies going forward. Everything else on this cash flow statement's about what you'd expect. As you'd expect in the most recent quarter, they did have a decrease of cash, but it was just $140 million. And I say just because when you come up here to the balance balance sheet. The company has a fair amount of cash, okay? They've got about $2.6 billion just sitting there in cash. They've got about $7 billion in assets, which is probably a little sneaky because they have some loans held for sale here and some other investments. So yeah, financially healthy company. Okay, they'll be able to survive. In my opinion, they'll likely be able to survive not being able to make money for the next 2 years. If their growth starts to slow, that could definitely impact the stock as well. I think you still have a lot of risk despite the big drawdown in the stock. And then quite frankly, from a technical perspective, you're still essentially just in kind of this a big downward channel on this one. I mean, I don't know how you want to draw this in. We did on previous analysis over at Affirm, there was this green line right here at $49. I tell you what, once you broke through that, that's where your stop loss should have been. If you were in Affirm, your stop loss should have been the previous lows. That's a great place to set a stop loss. If you're in Affirm at a much, much higher price, and I mean, we're talking about 5 times higher on this stock, maybe even a little bit higher than that. That means this stock from a market capitalization perspective would have to get 5 times higher. So this company needs to go back to 15, 20, $25 billion to get the price back in these ranges. And when I'm looking at these financials, I just simply do not see a 15 or $20 billion company here yet. You're going to do about $1.3 billion worth of revenue. So yes, if this company were to be able to double back to about a $10 billion company, I mean, you're still paying like 7, 8, 9 times sales on a company that, again, not going to be profitable. And because they grow their sales, the vast majority of that comes from marketing, okay? And yes, I understand they're capturing these customers now. They're going to be able to remarket to those customers, and Affirm does a nice job. Look, I just want to make it clear. I like Affirm's product. I use Affirm's product. I tell you what, when I can buy something at 0% interest and pay 4 to 6 months, I'll do that every single day of the week because it improves my own personal cash flow. I like this company's product. I think it's a fantastic product. From a stock perspective, though, I still think some needs to be worked out for this to be a good investment, but they do have a really, really good product. They have a lot of competition in that market as well. Now, again, from a technical perspective, we're locked in this channel. And yes, we've seen a green candle show up today. And quite frankly, when you flip up to the S&P 500, here we are in this downward channel. I'd be absolutely stone cold shocked, folks, if we don't see some massive big green candles start showing up on the S&P 500. In fact, if it made this type of move, that would be over a 10% move. It would not surprise me one bit. The S&P 500 rallies 10%, maybe in a day, maybe in a week, maybe over the course of the month. But guess what? Let's zoom this out, folks. The S&P 500 could zoom up 10% from today, and it is still locked in this downward channel to where you have to assume when you form these technical downward channels, you have to assume they are going to be in place until they prove themselves otherwise. The proof otherwise is we break above the channel, and this is just temporary proof. It's not a guarantee, because I tell you what, you could have moved the downward channel to here. We broke above it, and now here we are back in this channel, and we're back all the way on the bottom of it. More than likely what's going to happen is you're going to have relief rallies, and you're going to put up another big gigantic red candle pulling you back down either to the bottom of this channel, potentially breaking below it. You have to assume this technical pattern is in place, and you might be asking yourself, well, how does that relate to Affirm? Well, Affirm is in the same technical pattern. It's bottomed out down here at the bottom of the range at about $14, $15 per share. Looks like we're putting up a green candle to the middle of this channel to 23.24. Wouldn't surprise me one freaking bit if Affirm is able to rally all the way back to the 30s. So if you have a little bit shorter term mindset on the type of trades, I tell you what, these beaten down stocks that we beat down from a fundamental perspective, well, they have been absolutely destroyed from a price perspective. So you'd expect some pretty large bounces off the bottoms, but you've got to understand, for this stock to really break out of its downtrend, it needs to get back to close to $50 or nearly double the price it is today. which means the market cap would double, which means we'd go from a $5 billion company to a $10 billion company. We've got to get to a $10 billion company on Affirm just to break out of the technical downtrend that it is in. And are you telling me a stock like this is worth 7 to 8 times forward revenue sales? When you go and look at the price to sales multiple of Amazon, you go look at the price to sales multiple of maybe of Shopify, which is one of Affirm's best customers. You go look at the price to sales multiple of Apple, of Microsoft, of Tesla. And I tell you what, this stock still looks richly valued at today's prices. $5 billion valuation is not totally egregious. But again, when we factor in, not in a vacuum, that multiple stocks, many stocks, including like the Facebooks and the Netflix, these stocks have pulled back 40, 50%. These types of stocks that are profitable, have cash flows, some of them pay dividends, some of them are doing massive buybacks. Most of them have a much larger opportunity, and some of them have even less competition than Affirm. In that vacuum, Affirm doesn't look like that great of an investment. But I tell you what, if just this stock was down 80% year to date, sure, you take a flyer on it. But I just wanted to frame it and remind you guys, the entire market, including cash flow positive and cash rich companies, have been absolutely decimated. I don't think we need to go to the bottom of the barrel, which is kind of like Affirm, and make some risky plays, especially from a longer term perspective. But from a trade perspective, the high beta, Cathie Wood, high flyers, well, I tell you what, we're probably going to see some double-digit bounces in these names on both sides of the trade, up and down for the time being. So if you're a buy and hold investor, quite frankly, you might want to avoid names like this until the market volatility starts to even out. Tried to give a piece for everybody out there. The short term, maybe a firm trader. The long-term person, maybe somebody that wants to continue to short this stock. There's a little something for everybody in this market. Super exciting time. We'll certainly be back again soon to talk about more, but good luck with your investments.